January 2017. Now, the first day, obviously, no trading. And the first day of trading is going to be a Tuesday. So, what I'm looking at here is the Stock Trader's Almanac, which is pretty reliable based on my own backtests, except for when it talks about certain industries. But for a week-to-week basis, this is pretty reliable. And it also gives you some daily seasonality as well. So I was testing out this daily seasonality, the small caps punished first day of the year for the Russell 2000. It's basically 50-50 here, 50-50 bet. So I didn't put much stock into it, but I did take the trade, which is actually against me now. It's gone up. This is IWM, the ETF you want to use if you're trading the Russell 2000. The trade went against me. And I don't blame the Almanac because I actually looked at the stats myself and I came up with an 80% probability that it would be down if it opens high. And I've used this algorithm for quite some time now, making a lot of profit with it. Essentially what it does, I'll give you a picture of the probability chain in a second, but essentially what it does is it looks at the current trend in the stock and sees if we can find some patterns. And the patterns I'm looking at are based on a single state. There are 4 states. What's going to be the next state? What's the probability? So I'm going to show you these 4 states. You'll get a pretty good idea of it in a second. Alright, here they are. Move them over the screen. And I can't take them out. So, here, I'm just going to... how do I do this? Okay, I can move it over like this. Alright. So, what we're looking at are the 4 states of the market, of any stock. This one is for IWM in particular. White candlestick, black candlestick, up and down. Up and down refer to what the stock's position is relative to its previous close. So up would be higher than its previous close, down would be below its previous close. White and black refer to the candlestick. Based on this model, you'd only be trading at market open and market close. So at market close, you either have a white or a black candlestick. At market open, you're either up or down. Now, for IWM, given that you're up as the market opens, you got an 80% chance of it falling. And I think that was the case, unless I made a mistake. Is this IWM? Yeah. So you can see it opened up. It opened at 153. And based on that model, we had an 80% chance of it falling. Now, there's, of course, a 20% chance of it rising, and that's what happened today. But this model is pretty reliable in the long run. I've been using it for quite some time. You care both about the probabilities and about the expected values. So there's more to this model than just this picture. We also have the average movement, the expected value, which is the most important part. And that essentially tells us, for example, if the market opens up, we have an 80% chance of being black, 20% chance of being white, but obviously those aren't going to be evenly weighted. For example, if it's white, generally you're not going to be seeing the same size white candlestick as a black candlestick. Some stocks have the propensity to create big black candlesticks and a bunch of stable little white candlesticks. Now for IWM, the black candlestick is actually quite large. So this made the play a lot more tempting for me. And the average gain for this play, assuming that it's up, was something like, over time, on average, per day, you'd be making like 70 cents for every stock option. You'd see a 70% or 70 cent movement downward on average. And that's pretty playable. Now, I'm always updating these models with the newest market data. so they're always changing. But if you get me on Twitch, if you want to ask me a question for a particular stock, I can bring up this model for that stock, and we can look at it together, figure out how you should trade that. For a lot of the stocks that have strong patterns, like IWM does have a strong pattern in the case when it opens up. Those are tradable like every day. You could just trade it the same way every day, buy it open or short it open, and work it out like that. I'll show you one that I'm currently doing. I actually have a few, but we'll look at one that you can swing trade, which means you can buy when it opens and also buy again when it closes in different directions. For example, buy calls at the open, then buy puts at the close. Closing your calls at the open and then closing your puts. Closing your calls at the close and then closing your puts at the open. I believe I'm doing this with PayPal. I'm not sure at the moment. I would have to go look at it, but I think I'm looking at my spreadsheet right now. I'm looking for one where I have both a long and a short criteria to play. Okay, IWM, we can do this. I'm not going to be doing IWM, I don't think, but here, it seems to have a pattern, so I'm going to bring that chart back up. So it seems to have a pattern where at the end of the day, you take a long position, and at the open, you take a short position. Now obviously these other probabilities aren't as good as this 80%. But when you look at the average movement for each of these states, you'll find that if you short when the market opens, and then reverse that into a long position when the market closes, on average you're going to be making about $1. You're going to be capturing about $1 movement of that per day. So if you're playing with stock options, for every option you hold, you're going to make on average $100 per day. Now these other probabilities kind of suck, but it's the average movement that counts. So you've got a slight advantage of for example, a black candlestick. If the day ends with a black candlestick, you buy at the end of the day. You've got a 5% extra chance that it will be up the next day. You have a 45% chance that it'll be down the next day. That extra 5% doesn't really mean a lot, but the fact that the upward movements are bigger than the down movements does mean something. And by doing that, if you're playing with large enough sums of money, or you're playing with leverage like you are with options, over a long enough time period, that is going to be a profitable strategy. So that's something you do. You swing trade based on these candlesticks. Each one essentially gives you a rule of what to do. For example, IWM, you'd have white, buy, black, buy, down short, up short. And that would be profitable for as long as this model holds. Like I said, I update it every day, and as soon as I see the pattern become weaker, I stop trading it. Anyway, back to the weekly preview. Essentially, the market's going to be pretty much flat this week. That's how it usually is. It looks like the Dow and the Nasdaq are going to be a bit stronger than the SPY. But again, what I'm looking for is anything that looks strong in January. Either way, could be 100% up, could be 100% down. And one of the best ones I found for January, just for a buy and hold, if you want to play in the short direction, is JDST. That's the ETF on, exactly what's the ETF? It's like the gold miners, the junior gold miners bear ETF. So here, if you're buying this, you're getting 3 times leverage when the gold miners go down. That's GDX is gold miners, but then I think it's maybe it's JNUG. Yeah, that's the opposite direction. So what we're dealing with is JDUST, JDST. And what's great about this one is it has a very reliable pattern in January. It's been down every January in the current volatility regime. which means well, every market has a pattern, and the current market we're in has lasted from about 2012. At that time, volatility changed. We used to have a very volatile market, but in 2012, it really became a lot less volatile. So we have to do our analyses in that market. Now, what I got for JDust, I'll show you in a minute, is a very strong pattern in January. So I'm going to be taking, I already have a short position actually. I'm going to be taking a short position with options as always. And what we're getting here is, again, I cannot drag this over for some reason, but what we're getting is a very strong negative Sharpe ratio in January. The average gains in January for JDust is below 30%, negative 30%, and the percent positive is 0. In other words, since its induction, which was, I looked back as far as you could for this one because it was added to the market listings in 2013, it has never had a single January that has been anywhere positive. The average is negative 30 something. The most you've ever seen it draw down was 50% downward. So if you're going with historical data, as you should be, if you're making trades based on data at all, this is a really safe downward play. And if you want to carry it into February, you can. There's a little bit of risk when you go into February, but for the most part, this looks like a really safe play. There is some seasonality here, which is good. I want to see that on a 3 times leveraged ETF. If I don't see that and I see everything's negative, it just tells me it's a bad ETF. It's going to be hemorrhaging money regardless of seasonality, and I'm not really trading on patterns. I'm just fooling myself in that case. Here we do see some seasonality. It's stronger near the end of the year, and it's very weak at other times. So this is very highly likely to be an actual seasonal pattern in gold, or at least this ETF that is based on gold. So if you're going to open a monthly trade this week, I suggest you take a short position on JDust that is shorting the bear market. In other words, if you don't play options, or if you're not willing to short this, you just go long on the other one. You just go long on, I think it's JNUG. The thing is, if I were to backtest this, I doubt I would find 100% upward rate, because when you trade a 3 times leveraged ETF, there is the way it's set up is not in favor of the longs. The way it's set up is in favor of the shorts, because as futures roll over, you're going to lose some of the value. You can look up why that happens. I'm not going to explain it here, but just know that it happens. And I can kind of prove this for you when I run the same backtest on JNUG. And I doubt it's going to be 100% up in January. Alright, so as I expected, it's around 75% up. The average is a 30% gain, so you're still getting essentially the same average movement, but without the reliability of shorting JDust. So if you don't play shorts, you don't like short positions, and you want to take a long position based on my data, go with taking a long position on JNUG. Again, you generally don't want to hold 3 times leverage ETFs. You don't want to be in the long direction. You want to be in the short direction because all things being equal, you're going to profit no matter when. But the best thing to do is to look for seasonality in that ETF and find the leverage version, and then take the short version that corresponds to your thesis. So if you're long, find the 3 times leverage bear and short it. If you're short, find the 3 times leverage long and short that one. So here what we're going to do is we're going to find a strategy that works on JDust in the short direction. And what I have done here with my own portfolio is I opened a put back spread. If you don't know what a put ratio back spread is, you can, I'm not sure if I made a video about that, but you can certainly ask me to make a video, and I will. What you're really doing with a back spread of that sort is you're selling the closer month and you're buying the longer month in ratios. You're selling, for example, one short month. Here we'll look at an example. So here's one thing you might do for JDust. We want to look at the options. So as you can see, JDust has a lot of options. Liquidity is pretty good here. What you want to do for this trade is something like this. Short one of these 48 January puts. That will give you $340 profit. Then look for the out of the money February puts. Something like the 40s. And then buy a bunch of those. So buy 2 of those. Now, you're usually going to open at a debit. You're not going to make money on this trade when you open it. You're going to make money when it pays off. But the idea here is that your delta here is going to be higher than the delta of the short leg of the trade because you have multiple versions of it. And if you are wrong because you sold one of the options, what can happen is that option expires and you make money on that, and now you're net long, and you could keep that long position or you can close it at a loss. If you're right, what's going to happen is the values of these puts are going to increase a lot more quickly than you lose in these puts. And based on your ratio, you're going to be making a lot of money once it gets down to the strike price of whatever your longer month is. So if you're at 40 and it surpasses 40, you're going to be making roughly, whatever that ratio is times 100 for every dollar it moves down. So if I'm doing a 2-to-1 ratio, just subtract the excess, so that would be 1, and what you got left over is $100 profit for every $1 downward movement in the ETF or in the stock. But other than that, there's not much to say about this week. It's pretty uneventful. Even the almanac doesn't really say anything interesting. My back tests didn't show anything really particularly amazing in terms of seasonal trades here. I mean, I'm still looking, of course, but for now the best thing I found was to short JDust, and another one is to short WBA, which is exactly what I'm doing. But I'm shorting WA as part of an earnings trade because they're reporting earnings on the 4th, so that's tomorrow. I don't think it's going to be up. I think it's going to be down, so I'm going to be shorting WBA, and clearly it's rising a lot right before earnings. I'm probably going to be buying even more puts right before they report earnings. My probability, I forget what probability I gave it for it to fall on earnings. But if you want to join Exposing Earnings, you can find the article I wrote on it. Also, if you want to get my daily trade, for example, when I play that Markov model, the model I showed you here, I didn't call it a Markov model. Anyway, you guys know what I'm talking about. I hope if you want to get those trades, you just go to my website. And I think the first page is the service where you can sign up to get daily emails on whatever I'm trading. So if you're interested in that, sign up for that. You can get daily trades. Other than that, I think what I'm going to do is I'm going to start doing these weekly previews. So if you want to know what's going to happen each week before it happens, get the weekly seasonality, check out my Twitch on Monday before the market opens. Or check out my YouTube channel, although it'll be probably a day up to 24 hours late. That's it. I'm going to end the stream. And I'm not sure if anyone's actually watching this. I'm streaming for convenience to make the video. If someone's watching, I apologize. Next time I'll have the chat open, but I don't know if anyone's watching right now. I don't have the chat open. So if you're talking and I'm ignoring you, that's not intentional. Alright, that's it.